Virtual protocol price prediction videos are everywhere. $virtual to $10. Next 100x AI coin. Charts with arrows pointing up and a thumbnail face showing shock. Here's what almost none of them explain first. What virtual protocol actually is, what drives demand for the token, and why most price predictions are storytelling with a token ticker attached. This is not a price target video. It's the structural breakdown you need before any prediction means anything. Virtual protocol, often written Virtual's protocol, is an AI agent launchpad built primarily on Base. The core idea: creators deploy autonomous AI agents, tokenize them, and let those agents generate services and economic activity on-chain. The native token, Virtual, sits at the center of that system. Every new agent launch pairs against Virtual in a bonding curve. Users buy and sell agent tokens along that curve until the agent hits a graduation threshold, historically around 42,000 Virtual in the curve, at which point liquidity locks into a permanent pool, often for years. Agent interactions, fees, and services frequently settle in Virtual or route through it. So Virtual isn't just a meme ticker. It's the reserve asset for launches, a fee currency, a governance token through veVIRTUAL staking, and the pairing collateral for an entire agent economy. Now here's where prediction content usually skips straight to the chart. Token price in the short run is dominated by sentiment, liquidity, Bitcoin correlation, and crypto market cycles, not by last month's protocol revenue divided by circulating supply. In the medium run, for a utility token like this, you at least have to ask, is demand for Virtual growing because more agents are launching, more fees are flowing, more Virtual is being locked in curves and pools? Or is price moving on narrative while usage flatlines? That's the honest framework, not number go up. Demand sinks versus supply pressure. On the demand side, Virtual protocol has real structural sinks. Every agent launch requires Virtual in the bonding curve. That's open market demand or creator-supplied liquidity. Protocol fees on launches and agent activity feed a treasury, and a portion has been used for buybacks and burns. Staking for veVIRTUAL locks supply for governance. Successful agents, names like AXP, Luna, and others in the ecosystem, create ongoing transaction flow through the pairing asset. On the supply side, Virtual has a fixed 1 billion token design, but not all of it trades freely. A significant portion has been locked, vested, or held in treasury and ecosystem allocations. Unlocks and vesting schedules matter as much as hype cycles, because a bullish narrative plus a large unlock is a familiar crypto pattern. Third-party revenue trackers show the protocol generated substantial gross fees during its peak AI agent meta in 2024 and 2025, tens of millions of dollars in some months, with lower figures in 2026 as the broader agent launch frenzy cooled. That matters for prediction talk. Revenue and activity are volatile, seasonal, and tied to crypto risk appetite, not a smooth exponential line. So when someone says, Virtual to $5, the serious version of that claim has to answer several questions prediction thumbnails never ask. 1. What's the circulating supply at that price? And what's the implied market cap? At roughly $500 million market cap, ballpark for mid-2026 levels depending on the day, a move to $5 implies a multi-billion-dollar valuation. That's not impossible in crypto, but it requires a demand story big enough to justify it, not just a chart pattern. 2. Is agent launch volume accelerating or slowing? Bonding curve launches are the engine. If new agent creation drops, one major demand sink weakens even if old agents still trade. 3. What is Bitcoin and the altcoin market doing? Virtual does not trade in a vacuum. High beta tokens amplify market direction. A structural bull case can still lose to a macro bear market for months or years. 4. Are buybacks and burns large relative to daily trading volume, or mostly narrative? A few $1 million of lifetime buybacks sounds impressive in a headline. Against tens of millions in daily volume, the math is more nuanced. This is why most price prediction content fails structurally. It extrapolates a line from a 90-day chart, adds AI buzzwords, and ignores tokenomics. Or it compares virtual to a previous cycle's winner, the next Solana, without comparing user growth, revenue, unlock schedules, or competitive launchpads entering the same niche. There are bull case structures that aren't pure fantasy. More agent categories, gaming, productivity, onchain commerce, expanding beyond the initial meta. Agent commerce protocol letting agents pay agents, increasing transaction volume. Multi-chain expansion beyond base. Institutional or partnership flows. Crypto market entering a risk-on phase with AI narratives leading. There are bear case structures that also aren't conspiracy. Launchpad fatigue, hundreds of agents, few with durable revenue. Regulatory pressure on tokenized AI products. Competition from other agent platforms. Vesting unlocks hitting during weak sentiment. Revenue declining from peak while valuations still embed peak expectations. Both sides exist. Prediction content that only shows the bull case isn't analysis. It's marketing. If you're trying to think about virtual seriously, not as a gamble, but as a structured bet, 3 questions beat any influencer target price. 1. What measurable demand for virtual is growing, launches per week. Virtual locked in curves, fee revenue, active agent wallets. And can you see it in data, not just Discord hype? 2. What's the supply calendar unlocks, treasury movements, staking lock expiries over the next 6 to 12 months. 3. Is your thesis based on protocol economics or on category narrative that could rotate to the next AI ticker tomorrow? Quick recap. Virtual Protocol is an AI agent launchpad where virtual is the pairing asset, fee token, and governance layer, not a random altcoin. Short-term price is mostly market sentiment. Medium-term price depends on launch volume, fee flows, lockups, and burns versus unlocks and competition. Most prediction videos skip that entirely and sell certainty about an inherently uncertain market. The bull case requires growing demand sinks. The bear case requires taking supply and competition seriously. Neither looks like a single number on a thumbnail. That's the structure. Whether you act on it is your call, and this is not financial advice. If breaking down the actual economics behind crypto narratives is useful to you, subscribe. See you in the next one.